Ever found yourself pondering over the differences between QQQ and SPY ETFs? Let's embark on a journey to understand these popular investment vehicles, and by subscribing, you will continue to support the production of videos like these. Feel free to comment on what you would like to see next, thank you. Anyway, back to the video. On one hand, we have QQQ, often referred to as the QQQ ETF or the Nasdaq ETF. This exchange-traded fund aims to mirror the performance of the Nasdaq 100 index, which comprises the 100 largest non-financial companies listed on the Nasdaq stock exchange. This means it's predominantly invested in the technology sector. So if you're an investor seeking exposure to leading tech giants like Apple, Microsoft, Amazon, and Google, QQQ could be an appealing option. It's especially attractive for those who see potential in the growth opportunities the tech industry offers. On the other hand, we have SPY, an ETF designed to reflect the performance of the S&P 500 index. This index includes 500 of the largest publicly traded companies in the United States, spanning across a variety of sectors. Unlike QQQ, which is tech-heavy, SPY offers investors a broad exposure to the US stock market. This includes companies from sectors such as technology, healthcare, consumer discretionary, and financials. Because of its diverse portfolio, SPY is often considered a benchmark for the overall health of the US economy. Comparing the two historical performance data shows that an initial investment of $10,000 in the SPDR S&P 500 ETF Trust would have grown to $50,972 with a compound annual growth rate of 7%, while the same investment in the Invesco QQQ Trust would have grown to $53,443 with a slightly higher compound annual growth rate of 7.21%. Now that we've introduced QQQ and SPY, let's dive deeper into their performance metrics. Performance metrics can tell us a lot about how these ETFs have fared over time. Let's start with the compound annual growth rate, or KGR for short. This metric gives us a sense of the average yearly growth rate of an investment. Historically, QQQ has shown a slightly higher KGR than SPY. To give you an illustration, an initial investment of $10,000 in QQQ would have grown to $53,443 with a CAGR of 7.21%. The same investment in SPY would have grown to $50,972 with a CAGR of 7%. However, it's crucial to remember that higher returns often come with higher risk. This is where the standard deviation, or SPDR, comes into play. It measures the volatility of returns. The higher the SPDR, the higher the risk. For QQQ, the SPDR stands at 23.42%, indicating higher volatility compared to SPY's 15.42%. The Sharpe ratio is another important metric to consider as it adjusts the returns for the risk taken. It's a measure of risk-adjusted performance. SPY has a higher Sharpe ratio of 0.41 compared to QQQ's 0.34, indicating better risk-adjusted returns for investors. But what if we look at the situation from a different angle? What if an investor had started investing when these ETFs were at their lowest? Despite starting with an 80% drawdown, QQQ eventually overtakes SPY, showcasing its resilience and potential for long-term growth. This becomes even more compelling when employing a dollar-cost averaging strategy, allowing investors to purchase more shares of QQQ at a depreciated value before its eventual rise. But performance isn't everything. Let's consider the costs associated with these ETFs. Let's shift gears and talk about another crucial aspect of investing, costs. When it comes to exchange-traded funds like QQQ and SPY, two key factors to consider are expense ratios and dividend yields. The expense ratio is the annual fee that all funds charge their shareholders. It's important because over time it can eat into your investment returns. SPY has an expense ratio of 0.09%. This low ratio reflects its affordability for investors. Now let's talk about QQQ. Its expense ratio is slightly higher at 0.2%. While this percentage might seem small, over the long term and on large investment amounts, the difference can be significant. Now let's move to dividend yields. Dividends are a portion of a company's earnings distributed to shareholders, usually in the form of cash or additional shares. A higher dividend yield can provide a steady income stream for investors. Here again, SPY takes the lead. It boasts a higher dividend yield of 1.37%. In contrast, QQQ offers a lower dividend yield of 0.68%. While this might not be as attractive for income-focused investors, it's important to remember that QQQ's primary draw is its growth potential, particularly in the technology sector. With all this information, how do we decide which ETF is better for us? Choosing between QQQ and SPY isn't a one-size-fits-all decision. It's a matter of aligning your investment with your individual goals, risk tolerance, and investment horizon. Let's quickly recap. QQQ, or the Nasdaq ETF, tracks the performance of the Nasdaq 100 index. It's a compelling choice for those seeking growth opportunities, particularly in the tech industry. With a focus on leading tech giants like Apple, Microsoft, Amazon, and Alphabet, QQQ has shown resilience and potential for long-term growth. Despite its slightly higher expense ratio and lower dividend yield, its historical performance data suggests a slightly higher compound annual growth rate compared to the SPDR S&P 500 ETF Trust. On the flip side, SPY mirrors the performance of the S&P 500 index, providing broad exposure to the US stock market across various sectors. It's often considered a benchmark for the overall health of the US economy. SPY boasts a lower volatility, better risk-adjusted returns, and a lower expense ratio, making it an attractive option for investors seeking stability. Both QQQ and SPY have their unique strengths. QQQ offers high growth potential, while SPY provides broader market exposure and stability. It's all about understanding these nuances and making an informed decision that aligns with your investment goals. In the end, both QQQ and SPY offer unique advantages and can serve as valuable additions to a diversified portfolio. The choice ultimately depends on what you, as an investor, on what you're looking for and how you want to get there.